Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us here at AusBiz as we wrap up the day and the week. And it's we're ending in the red, essentially. I can't get away from that. The materials sector dragging the local share market lower, driven by commodity price pressure and a rotation into tech. So tech, the best performing sector, but materials very much the worst there, led by the big miners, the likes of BHP, Fortescue, and also the gold miners copping it in the neck today as well. And that's amid ongoing results from reporting season. I'll get to that in just a moment. Let's get to the themes of the day. Run over. Look, there's two ways of interpreting that. The recent record run we had on the local market is over, but also potentially, bang, bang, we've been run over today. For the week, I'm just double checking there where we're likely to finish. Looks as though about 1.8% lower on the week. Just waiting for the 1.7% on the S&P ASX 200. In fact, to be down around 0.9% at the moment. Baby's day out, that's reversed to Baby Bunting. Certainly a standout in today's results. It shares surging, which is a bit odd given what's going on in the retail sector. We'll get to that in just a moment. And Trump call, he's got a few calls to make, hasn't he? Certainly as far as what he's going to do in the Middle East, but also he did have a chat with our own Prime Minister, Anthony Albanese, overnight with our PM appealing for a bit of concession in regards to those new tariffs that he's lumped on us at 12.5%. Well, let's get to the sectors of the day there. As I mentioned, it's the miners that were the poor performers today. BHP off more than 3%, similar moves there with Rio. Fortescue, South 32. MinRes bucking the trend there, is finishing in the green. And the gold miners, they fell heavily today, led by the likes of Northern Star and Evolution. Whereas there was that rotation into tech. Why is tech up almost 5%? Xero up 5.5%. Let's get to those top stories then. Led by what we're hearing out of reporting season, QBE lifting first half profit 4% to just over $1 billion, helped by higher investment income and lower than expected catastrophe costs. Contact Energy, July electricity and gas sales jumped to 27%. PEXA selling its Value Australia business as it continues to exit its digital solutions operations. Storage King, its profit down almost 50% to 154 million as revenue fell around 30%. And IPD Group had delivered a record FY26 with revenue up 17% to 414 million. Elsewhere, Baby Bunting, as I was talking about there, lifting annual profit more than 17% to 11.2 million, 6% revenue growth, and expecting pro forma profit to reach 19 to 21 million in FY27, saying the outlook looks promising despite the pressure we're seeing in the retail space. Bell Financial, that reported after Bell yesterday, more than doubling its first half profit to a record $21.7 million. Now, off the back of those results, turn to our stock of the day. It was IPD Group, and Nadine caught up with Luke Winchester from Area of the Capital and Dean Fergie from Cyan Investment Management.
Yeah, I mean, the volatility is interesting. You sort of see the stock up kind of 15% today, but which only brings it back to where it was trading kind of 3 months ago. So, that's a bit of a feature of a lot of these stocks. It's certainly in an incredibly hot sector, but it's a strongly performing business at still on relatively attractive multiples. I think there's a lot to like it, and I'd be quite comfortable seeing this in my portfolio.
17 times earnings, not expensive, especially compared to some of those peers, not just in the sort of infrastructure space, but as Dean points out, the electrical contractors are trading at some silly multiples as well. So I'll agree to Dean. I'll pretty much agree with Dean's summary. I wish I'd own this one too. I don't, unfortunately. A little bit big now for what we're looking at, but I wouldn't hesitate to say buy for someone, a good industrial style business, good growth and a fair price.
Well, let's now wrap up the week with Shane Oliver, AMP's Chief Economist. Shane, welcome back. Good to catch up with you.
Thank you.
Let's start stateside because we had inflation read overnight was producer prices, consumer prices before that, pretty much in line. It does certainly dampen the prospect, perhaps, of an imminent rate cut stateside.
Look, it probably does. The money market expectations for a hike have well and truly come down for September. I would note, though, that the CPI was probably a little bit more benign than the producer price index. Some of the components in the producer price index that feed through to the core private final consumption deflator, and of course that is the one the Fed ultimately focuses on, were a little bit on the high side. So you did see some economists revise up their expectations for the core private final consumption deflator, which comes out, I think, in about a week or two's time. So there's still a little bit of risk there that if it comes in at 0.3%, which is possible, some Fed officials would flip over to arguing for a hike. But the general consensus seems to have been that the numbers were okay, and therefore that pressure for a hike in September has gone down. Now, that said, before we get to that meeting, there will be another round of jobs figures and another CPI. So there's a fair way to go before we get to that September meeting. But obviously, markets celebrated. The US share market went to a record high last night, partly helped by expectations that the Fed won't be undertaking imminent hike in rates.
Whereas, what's the outlook here, Shane? Because, of course, we did have the RBA decision on Tuesday, did hold rates as expected, but the focus very much on what we heard from Michelle Bullock. Given what she said, how do you rate the prospects, perhaps, that they will need to hike again?
Look, I think they probably will. Someone listening to me here might say, well, you flipped from being a relative dove a few years ago to now being a relative hawk. The consensus amongst economists, I think, is for the RBA to hold. There's a few of us out there who think that things are a little bit different now. The leeway for the Reserve Bank is less. Inflation will take longer to return to target, and therefore I think that ultimately means the Reserve Bank will hike again. Now, of course, if you look at all the RBA speak over the course of the last week, we got a statement, a brief statement after the meeting that was heavily skewed towards concerns about inflation. My colleague Me Boo did a calculation. There's 16 references in that two-pager to inflation versus only 2 in relation to jobs. Then we got that long statement of monetary policy, 70-odd pages there, and then we've also got the press conference and also an address by Deputy Governor Kent yesterday. I think Assistant Governor Kent yesterday. But the message, I think, is that they're still a bit twitchy here, that they're leaning towards another hike, and I think they'll ultimately deliver on that, probably in November. Now, even if we're wrong and we don't get another hike, I think a rate cut is a fair way off. You're talking the second half of next year before they'll be in a position to do that.
So, Shane, clearly investors here focused on that prospect, but also obviously we're in the midst of reporting season at the moment. Interested to get your view. Look, technically we're about halfway through, but really more of the bigger results to come over the next week or two. Given what you've seen thus far, how would you rate what you've heard?
Look, it's so-so. I think it's just level pegging, maybe a little bit on the downside. There were more companies surprising on the upside, and you can see it in that there, the bluish bars at the top are upside surprise, 33% surprising on the upside. The norm is about 40%. Less companies surprising on the downside, 25%. That's below the norm there as well. So there's a lot of companies stuck in the middle there. Only problem is that the banks didn't fare too well. Looks like the banks are starting to slow down. All of the banks now most of the banks anyway, talking about a slowdown in housing finance approvals or borrowings. And we saw that certainly in data released by the ABS today, although that data's a little bit lagged. It's for the June quarter. Some mixed results in there, Seek, saying that the jobs market is becoming tougher and that impacts them, but some others doing okay. So I'd say it's so-so. Contrast that with the US, where profit growth is literally booming. Expectations started at 24%. Depending on how you measure it, you're now at profit growth running around 33%, or if you allow for investment write-ups, it's around 50%. So very, very strong, particularly given that we're not coming off the back of a pandemic recession or a GFC. It's unusual to see this sort of rebound or strength in US profits. So very, and 87% of companies in the US have been surprising on the upside. So it's sort of little wonder that their market has gone up this week and up slightly, new record highs, whereas our market has actually given up some of those good gains we saw in the previous 2 weeks.
Shane, you mentioned what you've heard from the banks thus far, 3 of the big 4. In particular, what's going on in the housing market and the new home loans. In fact, I think we've got a chart. We can bring that up just to illustrate what's going on from a historical perspective. Where are we at, do you think?
Well, we're at the point where it's just starting to turn down. I mean, you can look at that chart and say, well, it's just a flip off the top. It's mainly investor finance which is coming down. The fall actually started before the June quarter, so this is now quarterly data. The ABS was doing some cost cutting, so had to cut back, I think, to make way for that monthly CPI. So this data comes out quarterly. You can see the red line there is investor finance. It's still at pretty high levels in the great scheme of things, but it did fall 10% in the last quarter, and that followed a more modest fall in the March quarter. So it's heading down. The banks themselves have indicated, falls. I think CBA said that since May there's been a 28% fall in finance applications from investors. So it looks like that red line has further to go on the downside. I mean, so far you would say, though, well, it's just part of a normal cycle, just like house prices or auction clearance rates, but it's early days yet. Whether it's a normal cycle or something deeper, they all start a bit like this. And so I guess it's too early to say. I mean, we think it will be, fairly severe downtrend, but not way out of whack with what we've seen, say, at the time of the GFC or that period 2008 to 2017 to 2019. But there's a fair way to go yet as higher interest rates, the tax hit to investors, and poor sentiment play out in the property market.
Well, also, we have that negative wealth effect, if you like, Shane, too, particularly if those who own a home are seeing the value of the home fall over time. I mean, is that likely to flow through the economy just in terms of perhaps pulling back spending, do you think?
Well, I think it will to some degree. So far, prices are only up 2%, which on average is neither here nor there. But in Sydney and Melbourne, it's 5.5%. In some areas in Sydney I know of, it's 15%. I've even heard anecdotes of people talking about much bigger falls than that. And they've had to withdraw their house from sale. But that affects their psyche, and those stories get around as it got back to me. It's probably not going to change my spending much, but I reckon if you had a lot of debt over that property and it's fallen by the numbers I've been hearing, 30%, offers 30% below where they paid a couple of years ago, which seems extreme. But anyway, that's the anecdotes. If that's the case, then that will have more of a dampening impact on consumer sentiment. We've heard from the Reserve Bank and others saying that the wealth effect is fairly modest, but it's still there. A 10% fall on my calculation, 10% fall in total wealth, of which housing is about 2/3, would typically knock about 1% off consumer spending. So not disastrous, but it would be a dampener on the economy going forward, in which that then becomes a dampener on jobs, which is why the Reserve Bank can't totally ignore it. They want to see house prices down a little bit as a sign that the economy is cooling, take pressure off demand. Government wants to see lower house, or they wax and wane on that. They were a bit contradictory, but they want to see lower house prices from the point of view of first-home buyers and affordability, but they don't want it to go too far because of the hit it will impose for most voters. So it's a bit of a balancing act, this one. But I think, we've still got further to go before we see the bottom of it. Well,
Shane, I dare say you won't be attending any auction this weekend because there's simply not many to attend. Thanks for joining us. Have a great weekend. Thanks for joining us on AMP.
Okay. Thanks, Andrew. Take care.
All right, let's catch up with then the winners and losers in today's trade. Seek making a comeback after having fallen post its result earlier in the week. I mentioned those tech stocks led by Block doing well. Xero also there, WiseTech. Whereas those that have fallen into the red, certainly in the mining space, develop leading the losses there. Mesoblast also coming off, actually a bit going on in the biotech space with some of those stocks falling. Purinex, again on that list, it has proved to be very volatile and has certainly copped it more recently. Let's turn to small caps. Look, actually, Dateline Resources back in their trend. They're up 30+%. Gallen Lithium also on the winners list. Bapcor, that's in the green. And those two have fallen. Optiscan Imaging down 18%. King River Resources and some more gold stocks in that list. All right, let's turn to what's out overnight. We do get a read on US retail sales, also consumer sentiment, and also growth, second quarter growth out of the EU and inflation out of India later. And next week, Australian consumer confidence, labour market data also. We do have the FOMC meeting minutes, second quarter growth out of Japan, inflation out of the UK and the EU, and of course reporting season continuing. Some of those results including BHP, JBHiFi, CSL, some biggies to come next week, and we're right across that, of course. So this is where we're finishing pretty close to 1% lower, so it has been a very negative session. That's also reflected on what we've seen on the S&P ASX 200. I'm just updating that chart. That's down 0.8% to be down 1.6% for the week. That is the COB. Thanks for watching and listening.